Hello everyone. In our last discussion, we were looking at IFRS 15, that is revenue from contract with customers, and we were covering the principle-based 5-step model for revenue recognition. Out of these 5 steps, we had already covered 2 steps, that is step 1 to identify the contract with the customer and step 2 to identify the performance obligation in the contract. In our today's discussion, we will cover 3 important terms, or we can say 3 important concepts that relates to the presentation and disclosure requirements under the IFRS 15. We will cover the remaining 3 steps in our later sessions. It is important to cover these 3 important terms before moving on to the further steps of the 5-step model. Reason being, these technical terms will be repeatedly used within those steps. Let's discuss 3 important terms or concepts under IFRS 15 related to presentation and disclosure. One is contract liability, second is contract receivable, and the third one is contract asset. Before diving into the definition of these technical terminologies, let's simplify these terms with an easy to understand example. After that, we will explore the definitions provided by IFRS 15 to deepen our understanding of these terms. So the 3 terms that we will focus in our today's discussion are contract liability, contract receivable, and contract asset. First, let's discuss contract liability. If a company receives consideration in advance from its customer, or if consideration is due from the customer but goods and services are yet to be provided in future, then in such case the company will recognize contract liability in its financial statement. I repeat, if a company receives consideration in advance, or the company has the right to demand consideration from the customer, that is, consideration becomes due from the customer, but the company has not yet provided goods and services, and it is obligated to provide goods and services to the customer in future, then in such case the company will recognize contract liability. So what is contract liability? Contract liability is consideration received in advance or consideration due from the customer against which goods and services are yet to be provided in the future. After that, the second important term or the second important technical jargon we have is contract receivable. Contract receivable is the unconditional right to consideration from the customer, irrespective of whether goods and services are provided or not. If, according to the terms of the contract, our company or entity has an unconditional right to consideration from the customer, regardless of whether we have provided goods and services or not, then the company will recognize a contract receivable. So the difference between contract liability and contract receivable is that contract liability arises when consideration is either received in advance or the consideration is due, but goods and services are yet to be provided in future. On the other hand, contract receivable refers to the unconditional right to consideration from the customer regardless of whether goods and services have been provided. If our company, if our entity has an unconditional right to consideration from the customer as per the terms of the contract, we recognize a contract receivable irrespective whether goods and services have been provided or not. Now let's move on to the third technical jargon, which is contract asset. Contract asset is the conditional right to consideration from the customer for which goods and services have already been provided. In situations where goods and services have been provided to the customer, means company has already satisfied its performance obligation under the contract, but consideration for such goods and services is conditional, means it is dependent on some future performance or occurrence or on happening or non-happening of some future events. So the difference between the contract receivable and the contract asset is that contract receivable represents the unconditional right to consideration from the customer regardless of whether goods and services have been provided. It does not matter we have provided goods and services or not. On the other hand, contract asset arises only after we have provided goods and services to the customer and have fulfilled our performance obligation under the contract. So contract receivable is the unconditional right, whereas contract asset is the conditional right. The condition can be any condition other than the passage of time. For example, it could be issuance of invoice, certification by a third-party engineer or surveyor, or any other performance by our entity. Remember, passage of time cannot be termed as condition against the right to consideration. For example, where goods and services are sold with a credit period of 1 month, 2 months or 3 months, then mere passage of time is not the condition. If the right to receive consideration is conditional upon something other than passage of time, for example, issuance of invoice or fulfillment of condition, then in such case we would recognize contract asset. Let's discuss each of these technical jargon with a simple example to make things easier to understand. Once we see this example, these 3 concepts will become much clearer. Let's say my college offers a course on financial reporting. The fee for this financial reporting course is set at $300 and the duration of this course is 6 months. Any student who enrolls in this course will have to pay the full fee of $300 upfront and they will receive financial reporting classes for the next 6 months. It is a common policy in many colleges that when you enroll for some course, you have to pay 100% of the fee in advance at the time of enrollment. Similarly, my college offers a course on financial reporting with a fee of $300 and our policy is that entire fee is to be paid in advance at the time of enrollment. If I talk about the educational services or teaching services, these are essentially services that are provided over a period of time. If teaching services are provided over the period of time, it means that performance obligation is satisfied over time and revenue will also be recognized over the period of time as well. So if it is a 6 months course with a total fee of $300, I can simply divide $300 by 6 months. It means that I will be providing services worth $50 each month and therefore I need to recognize revenue of $50 each month. Now I will try to explain the 3 important terms in 3 different scenarios. In the first scenario, a student comes and pays the full fee of $300 at the time of enrollment. So on day 1, when the student pays the full fee of $300, our cash and bank account will be debited by $300. However, on day 1, we have not provided any goods or services to the customer. Therefore, we cannot recognize any revenue yet because we have not delivered any goods and services to the customer. The goods and services will be provided to the customer over the next 6 months. But since we have received consideration, we have received payment from the customer in advance, we will recognize the contract liability. So when the student pay the full fee upfront in the first scenario, our cash and bank account will be debited by $300 and our contract liability will be credited by $300. We have received this $300 in advance from the customer, but the services will be provided over the next 6 months. So on day 1, we debit our cash and bank account and credit our contract liability. Over the next 6 months, as we progressively provide financial reporting classes to the student, we will gradually recognize revenue over time. For example, at the end of first month, if we have provided services worth $50 out of total $300, we will recognize revenue of $50. So at the end of first month, we will credit revenue in profit and loss account by $50 and we will debit the contract liability account by $50, reducing it from the initial $300. So at the end of each month, second, third, fourth and so on, we can provide, as we provide services worth $50, we will debit the contract liability account and credit the revenue by $50 each month. This was the simplest scenario where a student come to my college and paid the full fee of $300 in advance on day 1. When the student paid the $300 in advance, it means we have to provide goods and services to them over the next 6 months. So on day 1, we debited cash and bank account and credited the contract liability account. As we provide teaching services to the student over the next 6 months, we will debit the contract liability and credit the revenue by $50 at the end of each month. In the second scenario, a student enrolls in my course for the course on financial reporting and as per the college policy, the consideration was due on the first day. This means that as per the university, as per the college policy, the student was supposed to pay the $300 fee at the time of enrollment. However, the student actually paid the fee 2 months later. Despite the fee being due on day 1, the student delayed the payment and finally paid it after 2 months. In this case, what entry will we make? Well, at the time the student enrolled for the course, we had an unconditional right to consideration because according to the college policy, the student was supposed to pay the $300 at the time of enrollment. So the college could demand the $300 from the student at that time. This means that on day 1, the contract receivable of $300 will be debited, will be recognized. Now, even though we have not received any cash yet, but we have unconditional right to consideration from the customer, therefore we debited the contract receivable. But here a question arises, what will be credited here? Let's recall the definition of contract liability. Contract liability arises when the consideration is received in advance or when the consideration is due from the customer for which goods and services are to be provided in future. Either you have received consideration in advance from your customer or consideration is due from your customer but goods and services are to be provided in future, you will recognize the contract liability. In this case, when the student enrolled, our right to consideration arose on day 1 as it was unconditional. So we debited the contract receivable by $300 because our right to receive payment was unconditional from day 1. even though the cash had not been received yet. On the other side, we will credit contract liability by $300 because our consideration is due from the customer and we are obligated to provide goods and services in the future. So on day 1, contract receivable would be debited by $300 and contract liability would be credited by $300. Now, at the end of each month, as we provide services for each month, we will gradually satisfy our performance obligation. This means at the end of each month, we have to recognize some revenue for the services provided during that month. So at the end of each month, what will we do? We will simply debit contract liability and credit revenue by $50. On day 1, the student did not pay us. So we debited the contract receivable and credited the contract liability by $300. This was because our right to consideration was unconditional, contract receivable was debited. And the goods and services are yet to be provided in future, contract liability was credited. Now at the end of each month, we will continue providing services for each month and we will debit contract liability and credit revenue by $50 each month. 2 months later, when the student actually pays the fee of $300, we will debit cash and bank by $300 and credit the contract receivable by the same amount. So when the student pays after 2 months, we will realize the contract receivable that we recorded on day 1. In the first scenario, we only looked at the concept of contract liability. But in the second scenario, we covered both contract receivable and the contract liability together. In the third scenario, a special case arises where a student comes to me and asks for some guarantee that whether I can guarantee him that his exam will be cleared if a student studies financial reporting from me. In response to his request, I assure him that you can check my past results or take feedback from the former student. However, he expresses skepticism about my verbal guarantees. So I propose a special arrangement to him that he can attend the financial reporting classes from me without paying any fees upfront. I assure him that no administrative staff member will ask him for the fees until he completes the course, takes the exam and receives the result. And once he passes the exam, only then he will be required to pay us the fees. This approach aims to address the student concern and offer a solution that fits his need. In this special scenario, on day 1 when the student got enrolled, I do not receive any consideration because as per our arrangement, the student will pay after passing the exam only. I cannot even demand any consideration from the student because as per our arrangement, no fee would be demanded from the student until the student exam is cleared. So in this scenario, we don't recognize any general entry on day 1 because we did not receive any consideration in advance, nor was any consideration due from the student. Therefore, we do not recognize any contract asset, contract liability or contract receivable on day 1. However, 1 month later, 2 months later and so on up to the 6 months later, at the end of each month, we will continue offering classes and providing the teaching services. At the end of each month, we will recognize revenue of $50 against each month's performance obligation from 1 month to the end of month 6. Now the question arises, what will be debited? Have we already recovered any consideration in advance from the customer? No. Has any consideration from the customer becomes due? No. Has our right to demand consideration from the customer arisen? No. Has our right to demand consideration becomes unconditional? No. We assured the student that he would be required to pay the fee after passing the exam. Therefore, from 1 month to month 6, we will have a credit revenue by $50 each month, but this time the debit will not be the contract receivable or the contract liability. Instead, we have a debit to the contract asset. The reason here is that our right to consideration is conditional. It depends on the student passing the subject. The student is not entitled or responsible to pay until he passes the subject. This means my right to consideration is not unconditional, it is conditional. So at the end of each month, there will be a credit of $50 in revenue and debit of $50 in contract asset from 1 month to month 6. And after the course is completed, the student appears for the exam, and if the student passes, my administrative staff can start pursuing for the recovery of fees from the student. On the day the student clears the exam, my right to consideration from customer changes from conditional to unconditional. As soon as the student clears the exam, our right to consideration becomes unconditional. So when the student clears the exam, we will debit contract receivable and credit contract asset by $300. And then whenever student finally pays, whether he pays the next day, a month later or 6 days later, we will debit cash and credit contract receivable. In the third scenario, the condition was not the passage of time, rather the student clearing the exam. That's why we recorded revenue and contract asset at the end of each month. We provided services over the period of 6 months, but our right to consideration was conditional upon the clearance of exam. So we debited contract asset and credited revenue from month 1 to month 6. And when the student cleared the exam, our conditional right becomes unconditional. Then we debited contract receivable and credited contract asset with $300. And when the student finally paid us, we debited cash and credited contract receivable. Now, if you carefully observe and understand this relationship, you will understand the concept of contract asset, contract liability and contract receivable very well. Now, let's cover the definition of these terms under IFRS 15. First, we have the definition of contract liability. Contract liability is the entity's obligation to transfer goods and services to the customer for which entity has received consideration or the amount is due from the customer. This definition completely aligns with our understanding. If we receive consideration from the customer in advance or the consideration is due from the customer, but we are obligated to provide goods and services to the customer in future, then we recognize a contract liability. Then it further states that in these cases, the supplier presents the contract as contract liability when the payment is made or when the payment is due, whichever is earlier. This means that we have to recognize the contract liability based on whichever event occurs first. Either we have received the payment from the customer in advance or either the payment becomes due from the customer. So this was the simplest explanation of the term contract liability that we have. Next, let's cover the definition of contract receivable. Contract receivable is defined as the entity's right to consideration that is unconditional. If our company has unconditional right to consideration from the customer, it is termed as contract receivable. Here there is no mention of goods and services being transferred. Rather, it focuses solely on the company's right to consideration. A right to consideration is unconditional. If only the passage of time is left, then this right is considered unconditional. However, if there are other performances to be fulfilled besides the passage of time, or if there are other events or occurrences required, then this right becomes conditional. And then we have the third definition of contract asset. Contract asset refers to the entity's right to consideration in exchange for goods and services that the entity has already transferred to the customer. However, this right to consideration is conditional on something other than passage of time, such as entity's future performance. Remember, passage of time cannot be the condition here. If we are selling something on credit for say for 10 days, for 20 days, for 1 month, for 2 months, it is not a conditional right, it is an unconditional right. If only the passage of time is the condition, then it is an unconditional right. So what is the contract asset? When we have provided goods and services to the customer and our right to consideration is conditional, then we will recognize our contract asset. Now let's see the next phase of the lives of these three terms: contract liability, contract asset and contract receivable. If these terms are recognized in your financial statement, then how they will be utilized in future, how they will be derecognized, let's understand. If we receive consideration from the customer in advance, or if the consideration becomes due from the customer, for which we have to provide goods and services in future, we recognize contract liability. And as we provide goods and services to the customer in future and satisfy our performance obligation, we debit the contract liability and credit the revenue. So the next phase of the contract liability is recognition of revenue. Similarly, let's talk about contract receivable. If we have unconditional right to consideration, we recognize contract receivable. Now, how will contract receivable be subsequently derecognized? When our customer pays us, we debit the cash and credit the contract receivable, meaning the next phase of the contract receivable is cash receipt, or we can say recovery from the customer. In the same way, a contract asset represents our conditional right to consideration from the customer. When this conditional right becomes unconditional, the contract asset will be converted into contract receivable. Like in our third scenario, when the student exam was cleared, our contract asset turned into an unconditional right. So we debited the contract receivable and credited the contract asset. This means the next phase of contract asset is contract receivable. Contract liability will be concluded in the form of revenue and contract receivable will be concluded in the form of recovery from the customer. Practically, when we perform work for our customer but do not issue an invoice, we recognize the contract asset because we can only demand payment from the customer upon issuance of invoice. And when we issue the invoice, the contract asset is converted into contract receivable. This is also reflected in the practice where the revenue has been invoiced, a receivable is recognized. Where the revenue has been earned but not invoiced, a contract asset is recognized. So finally, we have covered these three important terms today, that is contract liability, contract receivable and contract asset. These specific terms might not necessarily appear in the financial statement. Asset and liabilities can be represented using any nomenclature that represents these concepts, ensuring proper communication of information to the users of financial statement. For example, if we have to recognize contract liability in the financial statement, we may use the term like advance from customer on unearned income or unearned revenue. These are as good as explicitly mentioning the contract liability. In the financial statements, we can use nomenclatures that effectively communicates information to the stakeholder. Contract receivable might appear as trade receivable, but the essence remains the same. These were some of the important concepts related to the presentation and disclosure under IFRS 15. I hope I have been able to explain all these concepts clearly in our today's discussion. With this, we end our discussion here. Thank you.